Okay, good morning, everyone. This is Jerry Price. Thank you for joining me today on the call. And what we're going to do is get started here with this presentation overview. We've got some folks here that have been here before, if you will. Getting some feedback here, and I'm going to mute everybody. And we'll come back later in the after I'm done, and if there's any questions, we'll try to handle them at that point, or we'll handle them one-on-one. But I appreciate you being here this morning. There's people that are here brand new, and some have been here for a while and just wanted to come in and check it out. I do have some upgrades on the May version that I'm going to articulate today that will help you understand the new things there. So thank you for being here, and let's get started. I'm going to scroll down here. There's some housekeeping items. The first thing is that you do have to have Microsoft Excel, the full version, to run this program. It does work both on PCs and Macs. And when you do receive the email file from me, I would suggest you save that, or download that spreadsheet, if you will, that file, and save it probably to your desktop or some other convenient location. And then once it's saved there, go back to that location and open the file from there. You'll be asked to enable the macros and the content. That must be done. To avoid confusion, since this is a monthly update situation, please delete previous month's versions. They won't work once the month end is passed. And then there are going to be light blue boxes throughout the pages, which you're going to be able to enter information either through a drop-down menu or numbers or text information. And then the other thing we're going to talk about is expanding to the full screen, so we can get rid of this area up here to have a full palette when you're doing things online, to have more of the screen available to your viewer. The page down and page up, mostly a page up or home button, is usable in an Excel program. If you get down a ways on a spreadsheet and you want to move up to the top quickly, those buttons, which are usually located along the right-hand side of the top of your keyboard, will get you up there quickly. And I do offer the calculator on a monthly subscription basis. There's basically 3 plan choices. You can purchase it monthly at $49.95 the first month, and then $24.95 each month thereafter, which ends up being about $324 for the full year. If you want to purchase a semi-annual subscription, that would be $125 for 6 months. Most people buy the annual subscription, which is $200, about a 33% discount. And I do use PayPal. If you don't have a PayPal account, let me know and I'll send you an invoice. But if you go there, just enter my email address, jerryprice10@hotmail.com. And once I receive your payment, I will get the calculator tool out to you, usually within 24 hours, but certainly no more than 48 hours. And again, my name is Jerry Price, and my phone number is 619-454-1399. Okay, with that in mind, let's get rolling. My calculator tool is right here on my desktop. I'm going to double click on it, and you'll see this come up. And the first thing that will be there will be this security warning, excuse me, which says, some active content has been disabled. You must enable that content to be able to utilize this. Now, you'll see another pop-up come up. It'll say this is how much time you have left on your subscription. In this case, it's May subscription, so there's 29 days left. But if you're a semi-annual or annual user, you will receive a program or an update automatically at the end of each month for the following month. During your paid subscription period, if you're a monthly subscriber, you'll need to go back to PayPal and pay the additional $24.95 each month for me to send you the update. Okay, so we're going to go okay to that. Now there are 6 questions here that I'm going to go through quickly. They open in sequence, and you have to agree to each and every one of those. It's from a compliance perspective. It keeps us all on the straight and narrow. First one says, I understand that this software is for training, education, and entertainment purposes only. And by using this software tool, excuse me, I'm acting in the best interest of my client as a fiduciary. Now we want to change that I agree. There's a drop-down, change it to I agree. Now the next one says, I understand that past performance is not a guarantee of future results. The use of alternative assumptions could produce significantly different results. It's another one you need to change to I agree. The third one says, I understand I cannot give tax or legal advice. Tax treatment is based on the understanding of current tax law, which is subject to change without notice or with notice. And I agree to that. And the next one says, I understand that any discussion with a potential client must be accompanied by an official life insurance illustration. Doesn't matter which company you're working with, but you need to get that because that has got the legalese, etc., about the disclosures and things. This software has not been vetted through all the insurance companies, etc., so it is something that needs to be worked with and respected as you go forward in using it. I agree to that. The next one says, I understand I am prohibited from printing this material. It's a visual aid only, except for printing a couple of things on a suitability profile, which we'll talk about when we get there, is allowed. Now, here's the reason that is there, is back, I got my license, my insurance license and securities license back in the early 90s. And at that time, we were coached and trained to never, ever, ever leave anything with a client that was other than what was published by the broker-dealer at that time or the insurance company. Well, that kind of holds true today, and anything yellow pad-ish or whatever it might be that you would scribble on and leave with a client could be used against you going forward should there ever be a case go sideways, so to speak. So to not allow that to happen, I think it's best to have this as a visual aid and treat it as such. So we need to, I agree with that. The last one says, I understand that for the integrity of the program, this is proprietary software. It's unlawful for you to give the program to anyone. All interested parties must obtain a subscription from myself, Jerry Price, at his email address, and all rights are reserved, obviously. But the bottom line here is that yellow tab. Once all these items have been agreed to, all the tabs will work and you can proceed. So if I were to click on any of these tabs, you see what happens on the menu there. But once I change this to the last one to I agree, they all start to work. So having said that, now that's kind of a pain going through that each time. So over on the right-hand side, once you've been through this a couple of times, you'll realize that you don't really need to go through that. You understand it as long as you're aware of it all. So I've provided two buttons over here on the right. Excuse me. The negative button will allow those to all go back to I disagree. You probably won't use that one. But the one you will use is this one right here, the plus. When you click the plus sign, you see all of them turn to I agree and you can proceed. So that's a little shortcut to start out with when it comes to that. Now, the second thing we need to talk about is let's get rid of this palette right here on the top. So this is all a full screen. So there's a tab called View on most of your Excel programs, and View has one toggle switch here that's called Full View, which when you click on that, you see that top palette goes away. And if you push Escape, that all comes back again. Further, you can right-click on that full view, and you'll see where it says Add to Quick Access Toolbar. You can take that and move it up here on your Quick Access Toolbar, and that's why it's grayed out, because it's already up here. And when you click on that, you'll see it goes away as well. Okay, so that's the full screen palette. We're going to go through these tabs one by one and do it as quickly as I can to familiarize you with this and give you an example at the end, and then we'll open it to question and answers if there are anything that we can cover at that time. So the first thing is the suitability profile tab. This contains two sheets, or two forms, I should say. One is the suitability financial and evaluation of financial profile. This goes down 3 straight pages, right straight below, you'll see. And you can enter data in here. There's drop down with some. There's check boxes. So the idea is you can go through this and get to know your client and understand them. And so you're making proper recommendations from the fiduciary perspective. Find out what makes them tick, how you can help them the most, etc. Gather other information about things that are coming your way potentially that you can help them with. And then there's a place for signatures here, and here's a place for notes here at the bottom. So the idea would be you've got an opportunity to print this out now, pages 1 through 3, and you can save it in a PDF format once you have it filled out, or you can print it out and fill it out, print it out in blank and then fill it out. But the idea is you need to get that form to your client to sign it, so they can then send it back to you, and you can have it in your file or either electronically or paper-wise, so you can have your bases covered when it comes to doing your fiduciary responsibility. That form does not go to the insurance company ever. It's just in there to cover you as far as your from a compliance perspective. The second form is over here on the right. It goes down 2 pages. It's a prohibited transaction exemption, 8424 disclosure. Now, you may use a form like this wherever you're using right now. You may also use a data gathering form like we had on the other one here on the left. But if you don't have those, these two are provided in case you do need them, and you can keep yourself out of hot water. This form is used when you're taking money that would be going into a qualified plan like a 401k, 403b or something, and recommending that it go into an IUL contract. We need to be able to disclose all the information about fees and costs, and we have to tell them how much we're making. We have to disclose all those information. We need to get their signature on it, and we need to put our information on there as well. Now, again, that's pages 4 and 5 when you print it out on this form to be able to print that and get it sent to them, your client, for signature, and then get it back to you. And again, this form does not go into the insurance company. It is to be put in your file to be kept for, I think it's 5 or 6 years now. This may go away, by the way. I'm hoping it does. But for the current time, it's not. It's still a viable situation. And once you do have that form, what happens when you do an e-application is you'll be asked in the application to attest that you've done this. So just know that this form doesn't go to the insurance company, but they're going to ask you to attest that you did it. So there's a reset button on all the forms here, and you see when you push reset, all these, whatever I would have opened up would have turned to back to the blanks, etc., and it moves the page up to a reset position. Okay, the next tab is a needs analysis. You may or may not ever use this, but it's here if you want to go through a quick what does it take to, when you're talking to a husband and wife, how much money they want to have to pay off debt, expenses, etc., and total this up for you dynamically. Then where's the money going to come from when it comes to funding it, current insurance, what they're putting away, 401k, tax refund, etc. That totals up as well. And then are there any movable money that you can talk to them about? And then secondly, is there any windfall profits or inheritances coming their way soon? Again, there's a reset button up here if you did fill out the form that you can utilize. Now, the next one is our LBL. Now, this is a static form here. It just is the red line and the blue line. It's a conversation starter. If you are, you can, however you want to start the conversation. If you were saving money, which line would you want to have it on? And almost everybody that I've asked, virtually everybody that I've asked, from ages 7 to 80 plus, have always said, I want my money on the blue line, but if they are saving money, it's always on the red line. The red line is the S&P 500 from 1999 to 2007. The blue line is the indexing process there compared. So you can spend as much time or as little time on that as you want to. I'm going to give you a suggestion on how you might use a portion of this calculator tool. You don't have to do it this way if you don't want to, but it gives you an idea of how you might present. And we're going to talk about red and blue here, obviously. The first question is there a better way to save? And the only way to answer that question I'm aware of is you have to compare it to something. Otherwise, the argument ensues and nobody gets to any kind of a bottom line as far as what it might end up looking like. Now, I'm going to do this in a story format. I was at the movies recently and waiting for the main feature to start, and there were about 6 previews that started, if you will, that played before we got to the regular movie. And those previews were designed, as you're aware, to put their best foot forward in that upcoming movie to entice us to come back to watch that new movie. Well, this is kind of a situation like that where we're going to give them a preview of what could happen, and they might want to come back to see how it might be personalized for them. So the assumptions here about the story we're going to go in, the assumptions are, again, this is for training and entertainment purposes only. We're going to use a lump sum example here in the process as opposed to a monthly. What I'm trying to do is explain and help them understand the devastating impact of these wealth killers and understand that mechanics and structure and characteristics of each one of those. But market risk, excessive fees, and taxes are just devastating on their attempts to accumulate money. So we're going to use a well-known S&P 500 index, and note that the S&P 500 folks and the money managers, I should say the money managers inside of most funds, mutual funds, etc., do not beat the S&P 500 year over year. And you might want to Google that. That is something that is pretty readily available on Google. Now, I'm going to push in a time warp here. We're going to go back to 1999. That is 19 years ago. We've got twin brothers. Their names are Red and Blue, ironically, and they're both age 40 at that time in 1999. Now, Red has worked for a company for several years and has accumulated $100,000 in that plan, and he's going to leave his money there even though he's moving on to another company, but he's not going to contribute any more money to it ever, not going to save any more money. That's his money for retirement. Blue, on the other hand, is made his money in real estate. He's accumulated $100,000, and he's going to put his money into an IUL contract, and we're going to compare the two. Now, neither are going to contribute any more money, and both are going to retire at age 70. Now we're going to talk about the rest of the story. Now again, I put a button here just so you know. You can click on top and your page will go back to the top there and you're ready for the next presentation. The next tab is Better Way to Save. Now here's one change that maybe some of you that have been on this before have not seen yet, but this is with the new way of looking at it. Sometimes we want to just isolate and talk about what the red line looks like without the blue line sitting here beside it. So I provided this opportunity to do so, and you can put, I'm going to use an example of a 40-year-old, our twin brothers here, and we're going to put $100,000 on that red line. Now you can go through this one by one, or you can open up the other side as well, and to open the other side you need to put some premium in that box, so it's $100,000 there, and we're going to change this to male. And we're going to do a 13% cap here today in our example. Okay, so you can open that up however you want to and work with it, but I'm going to go through side by side here. Just know that it comes up with just the red line open, and you need to put money here to get the blue line to show. So we're going to go through these wealth killers, market risk, excessive fees, and taxes, and then we're going to go through a wild card. We're going to talk about the S&P 500. This is the yearly returns year over year at the end of each year. This does not include dividends. It just is the published amount. That's that I've taken, and the source of that is at the bottom, so you can look at that if you need to. When you're on the red line, you're subject to all the ups and all the downs. So as we move forward into that process, and you have to choose a tax code when you're involved with the red line as well, whether it's 401k, IRA, 403b, etc. On the other side, we've got the indexing. We're going to have to choose that tax code, which is 7702 and 101A. We're going to use that cap, and we're going to start with $100,000 each. So 1999, the end of the year comes. We're up 19.53%, and we credit that full amount to the red line. We're limited here on the blue line to 13%. The ensuing 3 years, we're down 10.14, 13.03, and 23.37. That's the .com, that's the 9/11, and that's the full-blown recession in 2002. 119 went down to 107, 93, and 71, 575. You'll see a little tick, a red tick mark above the box, some of the boxes, and if you hover above that, you'll see the pop-up comes out that says any loss can never, ever, ever be recovered. Now, I had a little trouble with that when I transitioned from the variable world to the more fixed world, in that we were taught over there that if you ever lost money, just hang in there, you'll get your money back. Well, that is not really a true statement. It's true that the account value might come back to where it was, but you lost money that you can never, ever get back. And that is why Warren Buffett's 2 rules of investing are: rule number 1, don't lose money, and rule number 2, always refer to rule number 1. So at the end of the down years, there's always followed, it seems like, by an up year, since the financial advisors said, hang in there, it'll come back, and sure enough, it did in 2003. We're up 26.38%. Got to dig out of the hole here, so we're at 90,000. On the other side, we got those zeros, those 3 years of losses, so we didn't have any, and we're up limited by the 13%, so we don't have to dig out of the hole. It's 13% on top of 113. That's 127,690. Now, the ensuing 5 years were all up years through 2007, and we're at 119,450, about where we were when we started at our first year in 1999. All that time we paid fees on that, and we're not up. We're up probably less than the fees were charged. So then 2008 comes along. The mortgage and real estate meltdown, down 38.49%. Some people said their 401ks went to 101ks or 201ks at that point. So we're down to 73,473. Here zeros are here. We stayed at 167. In the ensuing years to 2017 were all up years, with the exception of a small blip downward in 2015 of less than 1%. So at the end of this run of 19 years, our red line account is 217,482, and our blue line account is 376,262. Now, a couple things to point out here as far as average rate of return is concerned. Sometimes you hear it referred to that the average rate of return is X. Well, that is, it's a true calculation, but it has no relationship to the value of a rate of return in the account. Average rate of return means you add all those 19 rates of return up and divide them by 19. That comes up with 5.73%. It's grayed out there a little bit. And you'll see on the other side, it's 7.38 on the IUL side when you take the zeros out and limit the up to 13%. But really, to come up with the rate of return, we have to use a formula called the compound annual growth rate. That takes the beginning amount and the number of years and the ending amount all into consideration. And the compound annual growth rate for this 19-year period of time is 4.17%, as compared to 7.22%. Now, it's not hard to understand why there's 173% more money on the blue line than on the red line, because you got more rate of return. So that is the first area, which is market risk, what we're trying to accomplish by limiting the loss, even though we are limiting the upside a little bit in this example. So the second wealth killer then comes along. We have not taken any fees out yet. So let's just say we have 2.5% fees taken off of that each year. So if we take 2.5% off each year and add them up, that comes out to $57,145. Your compound annual growth rate is now down to 2.52, and you have $160,000 left in your account based on that math there. Now, on the other side, there are costs in the IUL as well. Now, what I've done here is you'll see on the premium side, there's only 2 choices, and there's male and female here, and there's only about 4 choices here on the ages. I've run an illustration for each one of those variables or one of those situations. I've taken the money here, like the $100,000, and divided it by 5 and put $20,000 a year in for 5 years. Now, this is talking about back in 1999, so we didn't really have this kind of a program as good as it is today. So it's really a hypothetical example, because the illustration was run as if it was available in 1999. But be that as it may, the $20,000 per year for 5 years at a 40-year-old put into that contract, and you add up the fees for the first 19 years, they come up to $46,463. So to be able to compare apples to apples in the era of full disclosure, we want to make sure that people know that the contract that they're getting does have costs as well, and it is an insurance contract. So having said that, now our compound annual growth rate is down to 6.48 here and 2.52 on the other side. So that's the second wealth killer. The third one is the tax man coming along, and what's it going to be? Let's just say it's 33% for just discussion purposes. When you spend that money, you're going to have to take another $53,392 out of there, so you're down to $106,945. And if you have structured the contract on the IUL property, it comes out tax-free, and you can pull out expendable income $329,799 under those circumstances. That's 308% more money. Everybody I talked to today, an extra couple $100,000 in retirement would be a pretty nice situation. But really, there's more to the story than that, so you can pop this out. Again, all these things I'm showing you, you can do parts of it, you can do all of it, you can decide how you want to present it. But I'm just showing you everything that's here in the process. So, going forward, there's only 3 things that can happen to you. If you're a red line saver, or a blue line saver, you can either die too soon, become ill, or live a long time. If you die too soon on the red line, your beneficiaries are only going to get the account value less taxes. If you're on the blue line, our 40-year-old male is going to have a $541,518 death benefit, quote, tax-free, going to their heirs, income tax-free. If you become ill along the way on the red line, you're only going to get whatever's in the account and less any penalties and taxes if you can get at it. On the blue line, however, you've got up to $487,000 in living benefits, which, if it is triggered under current tax law, it would flow to you on an income tax-free basis. Now, the first one probably is not going to happen to you. It's less than 2% chance of that. The second one, there's much more greater chance of that happening, probably in the 40, 50, 60% range. The question is, how severe does that happen and whether it will trigger these living benefits, but our bodies do break down. But the third thing is probably where we should be shooting for, the projected annual income and living a long time. So when I ran out the numbers here, now if you can hover above this red line box, and this is the way I calculated it, on the government plan, a hypothetical illustration, 4.17%, 2.5% fees, and a 33% tax rate, the numbers come out looking like this. You'd be able to pull out $6,176 per year at age 71 through 90. Take it times 20, that's $123,520. The illustration reflects at age 70, $57,654. You take that times 20, that's $1,153,080 tax-free. Now, a snapshot at age 90, will show that your money is out on the red line. But if you do happen to pass away at age 90, there's also a death benefit, including the money that you've taken out of $452,683. Now, the program cost, if you compare those two, the program cost at age 90 is $197,940, and on the blue line, it's $87,029. So the first question would, or the next question would be, would you rather save your $100,000 like the red line saver or the blue line saver? Which twin brother would you like to be? That's your choice. I think it's pretty obvious, but most people you talk to don't know that unless they're in this industry, and even if they're in this industry, they don't know this. So the next thing is there's some more stuff down here. You never have to go here, but it's kind of for training and education purposes. We can go to a summary here, show it, and you'll see on the red line, the blue line, all the salient points, if you will, about each area, whether it's market risk, fees, taxes, and little comments that I made about it. In your partner area, if you're on the red line, you've got a partner, one of your partners is massively in debt and spends irresponsibly and is in total control of the accumulation and distribution. By the way, that's the government, and Congress can change the rules anytime they want. But on the other side of the equation, the blue line, folks, you're with a financially sound company, you're fiscally responsible, they're fiscally responsible, and you're contractually obligated to them, and if there's any changes, the history tells us that only changes will take place on future contracts and not on previous ones. So that grandfathering clause will probably be there going forward if it ever happens, and you can talk about this information as well. Now, we've talked about market risk, we've talked about fees, and we talked about taxes. There's actually one fourth absolute wealth killer, and there's probably more than this, but we'll just talk about these two, or this one, I should say, and we're going to show that, and you'll see the fourth absolute wealth killer is you. Either procrastination, or you need to save more money, or you got a critical illness that knocks you off your pins, or you're going to ignore it, 1, 2, and 3 that we're talking about here. Whatever it is, the question, if you ask somebody, well, how much money do you want at retirement? The most common answer is I either want $5,000 a month. I'm sorry, $5,000 a month from ages 70 to 90, or I would like $1 million in an account at that age so I can make it okay. Well, if you're 40 years old and you want to save that money and you haven't started yet, you're going to have to save $3,000 a month at these rates and fees, etc. On the red line, or you're going to have to save $630 under these circumstances on the blue line. If you want $1 million and you're 40 years old, it's $2,050 to get there, or $1,050. So you can decide how you want to deal with that when it comes to that process. Now, before I go to the next page here, I'm just going to show you, I should say before I reset this, I'm going to go to the next page. If we go to this red line, blue line tab, you'll see the red line, blue line that is established there, and that's based on these numbers that we put on here on both sides. If you were to change that to 250 and 250, that would be part of the process. One other thing I want to show you here on this drop down is I've had some comments about what about the taxes over here. If you wanted to compare, for example, that going up to 135, which in essence would be pre-tax stuff going in there, and compare it to a after-tax, you can do that as well. But there's those two cases are there. Since we're only using 100,000 and 250, I put in 100 and 350. I'm sorry, 100 and 135 and 250 and 350. So that's why those are there. And then I'm going to show you that there's a reset button here, and when we do that, you'll see all those go back to 0. And you'll see the palette returns back up here to the top, and you can start with your next presentation. And you go to the next tab, and you'll find out that this all goes to 0 as well, because there's nothing in those columns over there. Two things we need to teach people about is, the first one is indexing. And the first thing you'll see that this is blowing up a little bit more than it was before. It's to make it more readable. And the first area you can refer to if you need to, you see a T. Robbins up here at the top. You hover above that box, and you'll find a pop-out comes up, and that's a picture of Tony Robbins' book. And he talks in there about invest like the wealthy, where you participate in the market gains, but are guaranteed never to lose when the market drops. That's kind of a good situation. So here's what we're going to do. We're going to show this with the S&P 500, and here's the red line. We're going to put $100,000 on the red line. You'll see it flows down here to the blue line, and we're going to put that 13% cap there as well. Now, you've got some drop downs here when you have a choice. The market started at 1248, and we used to memorize these, and they would come to us, and we would do the divisions and all that stuff, but it ended at 1418. So the difference in 2006 of those two numbers, 170 points. The way you figure out that crediting is you take the difference, 170, divide it by the starting rate, and that's 1248. That means you were credited 13.62 that year on that account. On the blue line, however, you're only credited 13 because you're limited here by the cap. Now the next year starts at what the previous year ended up at. So you'll find at the end of the 2007 we're up a little bit, up 50 points. Do the division, both are credited 3.53%, and you'll see the red line is still ahead. Now 2008 comes along, and we had our mortgage and real estate meltdown. The market was down 564 points. You do that division, down 38.49%. You'll see we're down to 72. And here it becomes zeros are our hero, and the blue line, all of a sudden, it shows the difference of why you don't want to have those losses. Now the following year was up year, and you'll find it went up substantially, up 211 points. That's 23.45%. You're crediting both of those, and you'll see the blue line is still ahead. Now you can click through each one of those and go all the way out to 2018, but I provided you this fill button here. When you push the fill button, you can then see that it moves the palette all the way over to the right, and it fills in all those numbers. And you can kind of go through them. You'll see that the red line never catches up to the blue line. Here's last year. Now we're at 2018, and you can play some what ifs. What if the market closed at 2000? You can show that. It'd be down 25%, where zeros are hero. What if it happened to be one of those doomsday deals, 1500? If the S&P was down to that, you'll see what the effects of it are. You can show somebody in a real calculation, if you will, what would happen if it went to 1200. That's what happens to your brokerage account as compared to what would happen in your IUL contract. So now the question is, how does it work? So you can click on this button here I've provided, and you'll see the tab jump over here to how indexing works. And you'll see that you have a choice inside of your asset-based life insurance contract. You can take the guarantee, or you can trade the guarantee in for the ups and downs. You can go through that about the options and all that. I'm not going to go through that right now, but you can read that and understand it. It's there. If you want to play blackjack, you can have a little fun with that if you want. You can show a blackjack game where you have a game you win, you push, and you lose, and you always win as the person on the other side of the sitting at the table. Now here's another tab that you can show here where you can go back to the top without scrolling up. If you push the top, it goes back up here in this arena, so you can start again. There's also a reset button here which will allow you to push reset, and you'll see that everything that we opened up is now back to where you can start a discussion with somebody else again. Next tab is the tax tab, tax history. You'll find an image here that shows that back after World War II, tax rates were at 94%. Probably don't remember that very well, and most people, if they were alive at that time, probably wanted to forget it, or they may or may not have been in that tax bracket. But now we're all over here at 2018. So we scroll down here a little bit, you'll find that there is another image that kind of is appropriate. Our national debt is over 20 trillion, as all of us are aware, and counting. You'll find that this chart shows this area here is the actual federal debt, and the line running above it is the tax rate. So you can see this is where the 94% was after World War II. And as they paid the debt down, you'll see that the interest rate came down, and we got over in this area, and we had a little adjustment last year, or the beginning of this year. But the federal debt is still up here. Holy cow, what do you think could happen? Well, there's a book, if you hover above this word zero, David McKnight wrote a book called The Power of Zero, Tax Bracket at Retirement. And then there's a quote from David Walker, who was part of the Congressional Budget Office, that according to the Congressional Budget Office, the Social Security, Medicare, and Medicaid go unchanged. The rate of the lowest tax bracket is going to have to increase from 10 to 25, 25 to 63, and 34.9 to 88%. Holy cow, if it goes to anywhere close to any of those things, anybody that's depending on a plan that has never been taxed could be in trouble going forward. So that is there to have that discussion about taxes. Let's scroll that back up. The Money Last tab, we've got 2 more tabs to go here. We're going to talk about these. When you're saving money for retirement, it comes into 4 categories: your contribution and accumulation, and then it's going to be the distribution and transfer phase after that. So we're going to use an example here. Let's say you find a client that is 40 years old, that is saving $400 a month, that is already has $25,000 in their qualified plan, a balance now in their qualified plan, and they are in the 28% tax bracket, so they're getting enticed to get in there because they've got a deduction. And we've got a 4.17% rate of return, which as the last 19 years of the S&P 500, which I showed you on the Better Way to Save tab, how we got to that. And we're 40 years old. We put that in here, and then we're going to age 70. So we've got 40 to 70. We're going to end up with $373,689. Now, just so you know, the math is down here. So if you ever want to take a look at that, it actually is there for your viewing. So the first thing, which is kind of interesting to me, is the fact that when you have that situation, you've got $373,689. So write that number down just to show you this. And if you were to just take, there's no fees on this yet, if you were to just take 2.5% fees off that growing amount each and every year, the balance now is $224,713. Now, if you take the difference between that 373 and the 224 number, that's $148,000, and you divide it by that 373, that beginning number, that means that the 2.5% fee is going to take 40% of your money. Now, I don't know if that's devastating to you or not, but it's certainly, when you start thinking about it, it is pretty devastating that a little fee of 2.5% can take that much of your money. Back in the days when I was in the variable world, I remember John Bogle made the comment that a 2 or 2.5% fee would take 40% of your money. I didn't quantify that and wasn't able to do that until I really had this opportunity to be able to articulate that. Okay, so let's just go and open this. So now we're in the accumulation phase here, and we're actually going to even enhance the your client better or more. We're going to actually give them a 100% match. So now here's our scenario. We found a client that is saving $400 a month, has a 100% match, is starting out with $25,000 in their account. So when you take that from ages 40 to 70, they're going to contribute $313,000 over that period of time. They're going to get a tax break based on that, and over that time they're going to accumulate $409,582. Now, there's only going to be two numbers we're going to go up here to show distribution. Two numbers we're going to bring forward. One is this one, age 70, and the other one is this 409, which comes from here. The rest of this, now you're going to need to have run your IUL illustration to do a comparison. And you're going to have to extrapolate some numbers out of that. And we're going to start talking about the distribution phase now. And here's what we're going to talk about when it comes to that. We're going to need to have some taxes taken out. So I don't know what they're going to be 30 years down the road, but I think we better plan on being maybe 40% combined federal and state, maybe, especially if you live in California like I do. My guess is that's going to be the case. So the first question that comes up is, how much money could we pull out every year and not run out of money before age 90? So over here on this side, we've got a chart that runs from age 71 to 90. And we're going to see the distribution cases go out under those circumstances. And we're going to take a look at the fees and the taxes and all that stuff. So let's just say that we pull out 3%. Well, if you look over here to the right, there's still $74,000 there. So I want to get that number as close to zero or a negative number as I can. So let's just go to 3.5, or let's say this one here. Now let's go one more. So you got this little adjuster here, and it has a relationship only when it's taking into consideration the rate of return and fees and the tax math. So you see we're down here to a negative number. So what this is saying now is you can pull out, if you have a growth rate and a fee structure based on this starting amount of 409, you can pull out $23,892 to pay $9,557 in taxes to spend $14,335, and you won't run out of money hypothetically before age 90. So There's a couple of numbers I want you to take a look at here because we're going to move those numbers forward. I'm going to see if I can do this little drawing here and have a little fun with this. So the numbers you're going to need going forward to do our demonstration on the Only Three Things tab, you're going to have to take note of this one, how much money you put in. You're going to have to take note of this one, that you've got $14,335 on a monthly basis. You're going to have to take note of this, that you're out of money now at 90. And you're going to need to take note of this one. The plan cost you $405,722. So the question is, where did that come from, this money here? So you had fees all along here in the distribution, the accumulation phase of 160 and the distribution phase, which is these numbers adds up to the 160 and 103 is 264, and these taxes you're going to pay is 181,581. So you add those two together, and you've got this little tax break of $40,000 based on your rate right here. You'll find that your cost of that plan is $405,722 over that period of time. Pretty devastating stuff, I'd say, huh? Well, you need to note those so you can have those in there for your next page, if you want to use the next page in your demonstration or your discussion with somebody. Now, let's talk about the IUL. We've got some numbers we've got to extrapolate out of your contract that you put together for this 40-year-old, let's say preferred non-tobacco. Let's say you can only use that $400. You can't use the match, and you can't use the 25 because you're still working for that company. So if you take $400 times 30 years times 12, you're going to come up with $144. These are coming off your illustration now in that process. When you add up the fees all the way through age 90, it's 67, 438. These are numbers you need to get off your illustration. You're going to need to get the target premium off there, which is $4,800 approximately. And the next one we need to talk about here is this one in the middle, which is income. So the projected income in this case was $36,040. So here's what has happened under these circumstances. You were saving on the red line, and you had that numbers created there that you were going to be able to pull out $14,335 a year. But you decided you wanted to be able to pull more money out, like we are illustrating here on the blue line. And if you pulled out $36,440 out of your red line account, you would be out of money in 7 years, is what that is telling you there. So it's you'll see the blue line continue to run through all through the years and all the way up to age 120 is what the illustrations show in virtually all contracts. That's a little bit eye-opening. Let's say, for example, you could get a higher rate of return. Now, one of the I use AIG a lot, and one of the Maryland Strategic Balance Fund has averaged 6.28 over the last 20 years. Let's say you got that, and you were able to get out to age to 12 years if you under those circumstances. Well, you know, that's probably not going to happen. So you can just have that what if question or what if discussion. But you can note those numbers that you money lasted for 7 years at this 4.17 or 12 years, and then recognize that you now have a cost here, which is a $67,000, and when you down here under the tax rate, you did have to make more money to put in after-tax dollars. So we show that increased income as a fee, which really isn't a fee, but you did have to make more money to compare apples to apples. So you've got a fee of $107,758 on your blue line account. So the other thing that, the things that you need to note when you go forward to the next page is going to be the amount of money you put in, the income, the fees that cost age 90, and the distribution, and you're going to need to have the death benefit as well as the value at age, the death benefit at age 90. But we'll talk about that when we get there. The other thing we need to talk about is disclose our commission. So over on the right-hand side, you'll see this 4,800. You'll see a contract. You need a drop-down. You'll see there's a bunch of choices here. You can choose whichever is appropriate. So I'm just going to choose a 70% contract right now. So what you would disclose right over here on the right-hand side is this $6,840. And the comp, if you look over here, and I won't move over there, maybe I can. You'll see the pop-out, which explains the how that was calculated. Now, the question is, are we doing the right thing from a fiduciary perspective? And you'll see that there's a fee here that was charged in the red line area, which has been adjusted here because of what's taking place up here to 193,207. Now, if you go over here where we put in the fees before, that's based on 2.5%. Now, the brokerage or the third-party administrator and all those kinds of things have part of that 2.5%. But the person that's managing the money at Fidelity or wherever they are, they don't have a 2.5% contract. They may have something that looks more like 60 basis points, let's say. So if you apply 60 basis points to that, in this case, that 41-year period of time, the manager of the money would be paid $68,646, and we are paid $6,840. Now, I want you to know I was in this world at one time, and I got out of it. I had my Series 65 license, etc. And I've discovered that, yes, there's a need for that in some arenas, but the majority of the time in Middle America, they don't need their money, in my opinion, in a brokerage account like this. They need their money in a place where they can have living benefits, and the death benefit is part of their life as well as tax-free income. So our money comes out of the 67, that's what we're paid, and we're good to go. So the next thing, I want to show you the reset. I'm just going to reset this button, and you'll see what happens. All that goes back to 0, and the page returns up there to the top. Last tab we're going to go over, and then we'll talk if there's any questions and answers. This gets a little busy, but we're going to use AIG in the example here, and you're going to see you can put a place for the name. Now, this is where the plug-in numbers that I was talking about earlier, and we're going to put these numbers in. You can have already pre-filled these in if you want to when you're talking to one of your clients, or you can go like I'm doing right here and fill them in as you go. So our IUL contract had $144,000 in there. Our red line contract with our match had $313,000. The death benefit when you run that illustration for this 40-year-old is $301,671. I do virtually everything at level, but you can have a choice just to make a note of that there. Level increasing. We're going our fees to age 90. And we're going to do 90 on both sides of the aisle here. And the fees, or the costs, I should say, on the insurance side is $107,758, and on the red line side is $338,746. Now we've got what's the projected cash value at 70 on the blue line. This is from your illustration, 381,440. And what is the numbers off of the money last area where we calculated their brokerage account or their fund that they were accumulating money in under the red line. And we'll see that here we've got 14,000. 14,000 something or another, 14,435. I think that's what it was. And then we've got the projected cash value at age 90 is 311,257. And then we've got our money coming out of the contract, which we come off the illustration, 36,440. And we had the money last for 7 years at 4.14, and we had the money last 12 years at 6.28. Now you can have the discussion on this red line, blue line thing here a little bit more, talking about how much money they're going to have available. You can go through each of the points and discuss how this contract works and what it looks like. At age 90, for example, you're out of money here. You pulled out $288,700 projected. On the blue line, you pulled out $728,800, and you still have $311 in death benefits. So you got about a little over $1 million out of that contract by putting in $144,000 over that time. So the choices are this: you can do nothing. You can stay on the red line and continue to allow the stock market risk, excessive fees, and unknown future taxes to steal your financial wealth, and settle for $14,000 in net projected income from ages 71 to 90. Or you can change to the blue line. Eliminate stock market risk, reduce your fees, and eliminate future taxes, giving you a financial peace of mind and allowing you to enjoy the projected annual income of $36,440 to last you. If you tried to do it on the red line, it only lasts you 7 years at 4.17, or if you're selling the red line, you run out of money in 12 at 6.28. Or if you choose the blue line, you're going to last between 20 and 50 years in that process. So I guess the question is, which one do you like, the red line or the blue line? You tell me. Okay. Well, that is the overview, and let's see here. I'm going to stop. Let's do this here. Let's see what I can do here with this.